Welcome to the weekly update where I'll go over the action in the market for the week of June 2nd through the 6th, and we'll see how things look for the week of June 9th through the 13th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Had another up week, up about 1.5% for the S&P 500, and still looking pretty positive. We're not trending on the daily side. We're seeing a weakening trend here on the weekly side, but we're camped out right at the 6,000 level. It was acting as resistance on Thursday. We were able to break above it on Friday. Then it came down and acted as support. Then we ended up closing right on it after Friday's close. So we are seeing things turning back more positive. We're seeing some of our weekly charts looking better. We're seeing some of the big stocks, the FAANG Index, Facebook, Apple, Amazon, Netflix, Google. That has generated a golden cross on the daily chart, and it's starting to turn positive again here on the weekly side as well. Are we going back into that kind of an environment where we don't see necessarily broad-based strength? We're seeing a lot of churning at the sector level, but maybe the big stocks will be able to come in and really help things improve. Semiconductors are looking a little bit better, tech's looking better, but there's still a ways to go, and there's a lot of variables out there now as to what's going to happen going forward. Okay, so let's go back and talk about this week's session. For the week, we were up 1.5%. Volume is still below average. You still have a lot of folks that are not really comfortable with coming in and putting up really big positions right now. And so we consistently see below average volume every day. Now it's actually showing up here on the weekly chart as well. And we are looking better with our technicals. Now, one thing that's a concern is that in interest rates closed at 4.51% with the 10-year yield. That's where stocks usually start to have some problems. Now, the bond market closes an hour before the stock market on Fridays, and it closed, and then stocks still had another hour to go. That's when we saw the fade, where we came right back down to the 6,000 level. Now, is one being influenced by the other? Who knows? But with interest rates getting up to that 4.5% level, that's where we've seen in the recent past, we see some pressure. So if interest rates continue to go up, that may cause some problems for stocks more in the short term. Of course, if interest rates go down, that may give them more support. We're still not trending on the daily side, and we're seeing a weakening trend now on the weekly chart. So that's showing some improvement, even though we're looking pretty positive across the board. And the trade talks between China and the U.S., apparently that's going to resume on Monday in London. We'll see if anything comes out because of that. Now, the employment report came out on Friday, and it was actually better than feared. It wasn't really strong, but it wasn't weak either. It actually came in higher than expected. And so that's what I'm attributing interest rates to kicking back into gear, because there was some fear that there was economic weakness coming in, and we're watching the employment situation to see, okay, if this starts to fall apart, there's a greater chance that we're probably going to go into a recession. That's been put at bay for right now, at least for a little while. But the one thing that was wrong with this employment report is for the last few months now, we've been seeing them come in and revise down previous numbers. Now, the market doesn't seem to be paying attention to that right now. That could come into play at some point. And really no Fed speak. You've got the tiff between Musk and Trump going on, and that's kind of dominating all the pop news right now. And the Fed's just kind of sitting back there, not really doing too much these days, at least from what I can see. We're now in a weakening trend on the weekly side, where the ADX is dropping below the moving average. We're still negative, but the green line is starting to come up. The red line is starting to come down. I'll show you that chart. Okay, so for the week, the Dow was up 1.2%, and I have to turn on my pointer here. And the NASDAQ was up 2.2%, the S&P up 1.5%, as I said. And small caps had a pretty good week, but they really haven't gone anywhere. We've kind of come back to areas with the small caps where we've been before. Okay, so here are some bullet points. There was a lot of drama this week, the most prominent of which was the reconciliation. Now, this isn't a budget, this is a reconciliation bill. And there is a difference between the two, which is now causing a feud between Musk and Trump. It blew up on Thursday, and of course, Tesla got smacked for over 14%. It got about 3.5% of that back on Friday. The stock market did have another winning week behind the leadership of small caps. That helped, but we need to see more follow through with the small caps and mega caps. That's what I was talking about earlier. And when I go through some of the charts, I think you'll see what I'm getting at. Nvidia and semiconductor stocks had a pretty good week, but they need to keep having good weeks to really keep things going. The S&P did reclaim 6,000, but we ended up closing right at 6,000. So we got above it, then we came down, and it kind of went all over there. We are at 4.51% with the 10-year yield. And then OPEC came out and said, well, we're going to raise the amount of production in July. And that's keeping the price of oil down because there's more supply out there and it's less precious. And so prices end up going down. So that's helping that area. And then there's this world, I guess, group of people, the OECD. It came out with its global GDP forecast for 2025. It had been at 3.1%. Now it's at 2.9%. Okay. And then as far as US GDP, it had been at 2.2%. Well, they've revised that down to 1.6%. Now that is looking bigger picture and a different organization that's doing this. Then President Trump did come out this past week and said, well, that Xi, he's a pretty tough and extremely hard guy to make a deal with. But they had a phone call and apparently it went okay. And I don't know why Monday has MO big. So they're still talking. So that was taken more as positive. Then earlier in the week, we had the ADP employment change, which came in positive, but a lot weaker than expected. It showed that there were only 37,000 new jobs in the private sector. They expected 115,000 and none for small businesses, which actually went down 13,000 jobs. This is what started to get the market a little concerned. Okay, if we see a weak employment report, the Fed may have to come in and raise rates. We like that. But again, what's the context? Excuse me, cutting rates. We like that. But if they're cutting rates because of economic weakness, that may be short-term happy, but it's usually longer-term unhappy. Then the ISM services, I brought this up. I usually don't cover this in this video. I usually just kind of talk about it in passing. But it came in under 50 at 49.9. When it's above 50, that shows expansion. When it's below 50, that shows contraction. And these are the services. And the U.S. is a service-based economy now. We used to be agricultural, then we switched over to industrial. Now we've switched over to being services. If you've studied U.S. history all that much, and this is a bit of a concern. The market could have just tanked on this, but it really didn't. So that came out on Thursday. Even though we had a down day on that day, we didn't fall apart either. And then Elon Musk came out and he said, the one big beautiful bill, it should be killed. All right, so there's some things he doesn't like about that. And of course, instead of picking up the phone and calling each other, they have to take part in this with each other on social media, which brings everybody else into it and gets everybody glued to their phones or their computer screen or whatever they're watching as they're seeing this little spat going back and forth. But for the most part, it was just treated as theater. It really, it's pop news right now and everybody's talking about it. The Republicans are saying, well, it really didn't hurt us all that much. The Democrats are saying, ooh, yeah, this is trouble in paradise. This is just what we were hoping for. And that's usually how it comes, and then it'll kind of fade away and be replaced by something else. The European Central Bank did cut rates by 25 basis points, and that was not a surprise. But they also suggested that this might be it for as far as rate cuts. Okay, so I show this every week. This shows we're still tending to be where this blue line is, dark blue line. where we're decreasing with our inflation overall. And then I bring up this chart because it's comparing 1966 to 1982, where we just went into massive inflation back in the mid to late 70s into the early 80s before it really started to come back down. Just to be aware that things can change. They're not always going to stay the same. Things may look okay now, but a year from now, 2 years from now, 5 years from now, it could be completely different. All right, then we are above that 4.5% level with the 10-year yield. We're also above 4.02% with the 10-year yield. That's when it starts biting more into corporate profits, which has more of an impact on the small caps. Now, this was updated with Friday's employment report. These are long-term unemployed folks. It's ticking up just a little bit over here. It's not really, skyrocketing up, but it is increasing a little bit from the previous reading. And then this is a newer chart. This is only updated when the employment report comes out. I just wanted to go long term with this, where it's the employed usually working full time, because there's all different ways you can break this down. Part time, some people have multiple part time jobs, some people work a full time job and then kind of a part time job. This is looking at full time employment, and it's still holding up for right now. All right, then Isabel Net had their blog post. It says why stocks can hit double digits in 2025. When we're down 15%, we were actually down over 20%, at least on a closing basis, close. And then we were over 20% down on an intraday basis. But I don't know if I'd really pick all this out. Here's the lows that we had and then what the yearly return was. Not seeing an awful lot of positive numbers here. So I don't know how to really, twist this in a more positive way. Yeah, there are times when we really dipped. 2001, my goodness, we got hit with terrorist attacks. Okay. And then 1982, okay, we had a big down year, but then ended up finishing positive. And then 2009, that's kind of coming into the end of the financial crisis. And then 2020, of course, that was the whole COVID lockdown and the COVID crash and everything. Are we really equating what's happening now to what has happened that was pretty drastic in the past? Who knows? I mean, we're not even halfway through the year yet, and something could still happen. But I don't know if I'd really rely on this as a vote of confidence that we're going to necessarily go up. There's other things that we can look at that does give us some confidence, but not necessarily this chart. All right, non-farm employment annual growth from 1950 to 2025. We're actually coming down here. It's at 1.1% when you calculate this out on a year-over-year basis, the way this person does that. Risk premium getting very low. Typically what will happen is when we're really going down, that's when we see the risk of owning stocks, that you're paid for that. Basically, it's calculated into the price and the risk that people take. You can see when we were really going down, the risk premium got very high. It also really spiked back in 2020. It's getting very low right now, meaning that you're not getting compensated a lot extra for owning stocks. And the last week or so, we've been just chopping sideways. Yeah, we're positive and we could break to the upside and start getting some capital gains here. But just buying stocks right now and holding on to them, you're not really seeing any real big returns at this point. You're not being compensated for that. Okay, then the probability of a recession calculated from the yield curve coming down, starting to bounce back up, but then we had some weaker than expected reports from the economy that came out this week, so we ticked down just a little bit here. And then once we get the employment report, we also get this chart where we're down below the thick red line here. That's usually when we start to go into a recession, but that didn't happen this time. Now we're seeing the red line starting to come back up when we look at all employees, which also includes temporary help services. And then debt to GDP likely to continue to rise. Okay, especially with the big, beautiful bill adding $4 trillion to the debt of the U.S. Yeah, this is probably going to continue to go up. Then global stocks are near overbought. Global stocks have been outperforming U.S. stocks so far in 2025. Well, when you use an RSI based on 14 periods, which is what I use, we're getting up to this level here where we're considered to be overbought. It's not officially an overbought signal until we go above the red line and then cross down below it. But Bloomberg decided to show this chart. And then AI adoption. It's really being adopted by a lot of companies, really going up. I use it. A lot of my friends use it. A lot of people I know are at least learning about it and trying to use it as well. All right, then FactSet, we're not really in earnings season right now, but still made a couple of blog posts. The Magnificent 77 companies reported earnings growth above 25% for the first quarter. That's what's really driving things right now. You can see where they're the real thriving part of the stock market right now. And then what we're looking at in the past, and then what is projected to be off into the future. And then AI again here. A lot of companies not talking about it as much as they were back at the end of 2024. They're still talking a lot about it on their earnings calls. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Here is the intraday chart going with Monday. We had a nice little upward move there, and then things were looking pretty good on Tuesday. We had a nice, more sustained climb here, and then we pretty much held on to those gains. Then we just went into this sideways action here on Wednesday. Then Thursday, this was the day that we hit 6,000. This was a pivot point and also a psychological level at 6,000. We hit that and then just started coming down from there. And then everybody was waiting around to see what was going to happen with the employment report. It was positive, so we gapped higher. We got above the 6,000 level, came down below it, went back above it, and then drifted right back down to it. So the typical rule is that what was once resistance now becomes support. Well, this is a little short term, so we'll have to see if we go below 6,000. Of course, we'll see if any other support levels end up providing help at lower prices. But is the market going to be able to launch up off of here and possibly go back and set a new all-time high? All right, so looking at the indexes for the week, everything was up. We had the NYSE, which has been holding up better as the market was gyrating all over the place in March and into April, and then trying to bounce back up through May. The NYSE is actually it's still up, but not doing as well. And then we had the Dow up, the S&P was up. Now, these are just for the 5 trading days that we just got done with. It's not Friday to Friday. I do this purposely a little bit different. But small caps actually saw a little bit of love this past week. And then going back to the beginning of the year, let's see, small caps are still down on the year, as are mid caps. Both of them are still below their 200-day moving averages on the daily side, where we now are seeing things improve, with the NYSE doing the best so far year to date, with the NASDAQ 100, which is growth, the S&P 500, which is growth and value. And then, of course, you have the NASDAQ and then the Dow. So we're starting to go back and look a little more positive at this point. The sectors, we had an up week. We had tech. That's a growth area. That was up the most. Energy, which has just been getting hammered like crazy. It saw a bounce this past week. And then communication, which is another growth area, was also up. And then we get down here to discretionary. It ended up being down a little bit. A lot of that probably had to do with Tesla falling on Thursday. But then staples are going down and utilities were actually down. These two areas are typically seen as being more defensive. I know you can make a case that utilities are growth because we need so much for AI and for crypto mining and electric vehicles and all of that, but it's still basically seen more defensively. All right, then looking at the scooter score on a scale of 0 to 100, currently we have the communication sector, which is growth. That's good. It's looking about the best. It's into the 80s. Then industrials, which is more cyclical. If the economy's doing okay, then that area tends to do well. And then tech, getting into the mid 70s, where we still have healthcare and energy looking pretty bleak overall, even though energy had a pretty good week. Real estate has been under pressure too, because we have interest rates going back up. Staples kind of falling down a little bit here, which are more defensive. All right, so just looking at the 5 trading days for the sectors, where we had tech, communication, industrials, healthcare was up just a little bit. We had staples, utilities, but discretionary, again, just got hammered this past week. Now, going back to the beginning of the year, we still have discretionary, which is underwater. Improving, but it's the worst performing area so far year to date, followed by healthcare and energy, where we're seeing industrials showing some improvement there. Utilities have still been strong. Communication, staples are still positive. So we're seeing some kind of churning going through all of these different sectors, and I'll show you that here and then chart right after this. But this is the weekly chart of the market carpet, and you can see a lot of green, especially for tech. Communication was green, discretionary, not Tesla, but Amazon was up, and a lot of green throughout this area, where the more red areas were the more defensive areas, utilities and staples. Now, this is the relative rotation graph showing how things are rotating around here, where staples had been stronger, but now they're starting to show some weakness. Utilities are also starting to turn back down. Then we're seeing things like real estate showing some weakness. Now, the financials have been pulling back a little bit, but they've been holding up okay. Communication, again, a better area, but this goes back over the last year where it got hit with everything else in March and into April. Then you have materials showing a little bit of weakness, industrials coming on, and then energy, really bad, and healthcare, really bad. But we're seeing tech and then discretionary actually showing some improvement here. And this is what we want to see if we're going to go back over to a pro-growth type of market. And that's when the market really starts to go up. Now, this could all stall out. We've seen these things happening before, only to have them not come through. But we are seeing some, the defensive areas are getting more defensive. The growth areas are getting more offensive, which is usually more positive for the market. All right, so then looking at this in a different way, we still have materials, industrials, and utilities, which are green. More neutral would be communication, real estate, and staples. Negative, healthcare and energy. And the areas that are improving would be tech and discretionary. Then looking at the different indexes, you can see a lot of these. The S&P, the NASDAQ 100, the Dow Jones Composite, they're all just conglomerated right around the midpoint. And we've seen that for a while. Where utilities, again, this is the index. It's starting to show some weakness here. Transport, small caps, yeah, they had a good week, but they really haven't gone anywhere. We are seeing a little bit of improvement here with the mid caps. And then looking at the NASDAQ 100, the utilities, the S&P 100, which are the large caps for the S&P 500, and then the S&P 500 itself. The Dow Jones Composite, small caps, and transports are still looking more negative, with the mid caps showing some improvement. And sentiment, seeing a little bit of a tick down with the latest reading from Investors Intelligence. When we drop under 1, that's when we start to use this as a contrarian indicator, and we started to bounce up out of that. But in the latest reading, now this is a week old. This comes out during the week, and then it's from the previous week. So this data is a bit delayed. It did tick down just a little bit in the latest reading. And then the euphoria meter, which tries to take the forward-looking PE ratio, the VIX, and bullish sentiment and put it all together. It had become quite exuberant there, pulling back when we were going down. It's seeing just a little bit of a tick up in the latest reading. Now, this is what I follow every day, but I actually show this in the next chart in the weekly version of the videos. We're at 63 right now. Now, I don't call this greed. I call it positive. And then we get up here to extreme positive, where we were kind of going between positive and neutral throughout the week. And you can kind of see that here in the chart, where we were starting to get a little too exuberant, then we pulled back. Now we're starting to see some improvement here. And the name or active asset managers coming down in their latest poll, but not quite up to this 90 level yet. And we see the number came in at 81.62, a little bit of a decline from the previous reading. We are under 20 with the VIX, both with the line chart and the bar chart. So we've been seeing VIX readings that are quite high, but at least they're below 20. And that's when we tend to see positive annualized returns. And we are coming back down with the black line when we look at cash to the tech sector. When this is going up, that means cash is actually outperforming the tech sector. When this red line, excuse me, the black line is going down, that means the tech sector is outperforming. Still getting a pretty bullish reading here with the right X bear bull ratio, and seeing a little bit of a drop off. We were extreme negative with individual investors. Then we shot up and actually went positive. Now, for the last couple of weeks, we've been slightly negative with things. There's a lot of people that are gun shy about this market, which could actually end up working to its favor. And coming down as far as the Ulcer Index, but still above the moving average. We're under the moving average on the daily side, and still not seeing anything all that concerning here with the spread between risky and not as risky bonds. And then here's the inverted version of that. When this is going up, that means that fear is coming out of the bond market. Then the VIX and the 3-month average of the VIX and doing a ratio, this is continuing to go down. That means the VIX shorter term is coming down quicker than the 3-month average of the VIX. And that tends to be more positive in this context. We're still declining with the long term, 253 days, because that's about how many trading days there are, with the equity put call ratio. And when this is declining, that is more positive. As far as the economy, the weekly chart coming down a little bit here, but we're still within this general range that we've been in. The Chicago national financial conditions tick down a little bit, but the concern that we watch here is, do we go above the black line? We're not there now, so that's okay. And the latest reading from GDP Now, my goodness, they're the ones that kept predicting negative GDP. Now they're coming in just under 4%. They were actually above 4% earlier on. Now they're coming in just under that reading currently. Now, if you look at the consensus forecasts, we have about a little bit under 3% to the upside and down to 0 to the downside. This is another look at GDP Now, where they're having it positive. And if we can stay positive with the real numbers that end up coming out, that means we would not be in a recession. You have to be negative for 2 consecutive quarters. And then the New York Fed, they tend to be more jolly about things, coming in at 2.42. They have positive GDP forecasts. And now this was updated, but we're getting the same reading that we had last month. This is the real-time Psalm Rule Recession Indicator. We're still below this 0.5 level. I don't have the red line on here, but that's not a concern. If we get up to 0.5, that's when we start to get concerned. The perma bears love this because we got up above this a number of months ago, and they've been declaring the end of the world as we know it. But so far, things seem to be holding up. And then the smooth U.S. recession probabilities, we are coming up here, but we're still below this black line. Then this was updated, even though it's a quarterly report, it was updated on Friday, where the Braid Butters Kelly leading index is coming down, and that's actually positive. When this is really going up, then that's when we tend to go into a recession. Well, we were going up, and now we've been coming back down. As far as inflation, we will get CPI and PPI in the upcoming week, so these will probably adjust. Not really seeing any real big changes lately here. And it's pretty much a done deal that when the Fed meets on June 18th, they're going to leave rates right where they're at. 97.4% chance. They're at 4.25 to 4.5 now. They say after this meeting, they will still be at that level. And the market is pretty much locked into that. This is the dark blue. That's the current reading. Then we have a day ago, a week ago, and a month ago, and the market's become more convinced. So now we start looking out at the end of July for their next meeting, and there's an 83.33% chance that they're going to leave rates the same at that meeting, and the market's becoming more convinced of that as well. But these can change. We are still seeing the Fed balance sheet continuing to decline, and we're actually seeing a little bit of a tick down now on the year-over-year Fed balance sheet. And then not really seeing anything all that crazy here with the overnight reverse repurchase agreements. We look for some kind of spike up or spike down. This has been just kind of humming along here. That means everything's okay with the overnight lending with the banks. So no real cause for concern that way. All right, so looking at the weekly chart of the advanced decline line, we are still positive. We're above advancing moving averages here. So longer term, this is positive. Then we are improving with the new highs, new lows weekly chart, where we're seeing more new highs than new lows. So the 4-week moving average is going up, the 10-week kind of going up, but for the most part, the context is that it's going higher as well. That shows more internal strength coming into the S&P. We're above 0 and advancing with the 19 and 39-week advanced decline ratio. And then here's our trend. We're dropping below the moving average. We're negative because the red line's above the green line, but the red line's coming down as the green line's coming up. So this also suggests there is some improvement here now that the trend seems to be weakening. The Arun is still negative, where we're quite positive over on the daily side. And the red line, these are sellers, which are declining. The green line, which are buyers, this is also declining. That's why we're below zero here on this side. The mass index is not generating a signal here on the weekly chart. We're not seeing one on the daily side either. Here's the daily chart where we've just been chopping along sideways. We're still not trending, even though we're trying to break a bit to the upside, but there's just not a lot of conviction. And you can see this blue line is the moving average of volume, and we've been consistently below that ever since we just cratered down here at the bottom. You've got so many folks that are concerned that this market's just going to fall off a cliff again, which it may do, but things have been improving at least to this point. We're still above the 50-week moving average with the S&P 500. We're still in a downtrend, and it takes a long time for these lines to cross. So that's probably going to last for a while, but we're above both of the moving averages, a 13-week and a 50-week moving average for the S&P. Still looking good, climbing up above the midpoint here with the trend channel for the S&P. And we did break out just a little bit here on the weekly side. We're above the pivot. That's positive. And this formation here is looking better. Now, it needs to show some follow through. And are we going to go back and set another new all-time high from here? That's kind of what folks are starting to ask. Then we look at accumulation distribution. This is smart money indicator number 1. We are positive on the top here because we're above the advancing moving average. The boom indicator is also positive. We're going up and we're above the moving average there as well. We're positive here with the Chaikin money flow. Now on the daily chart, we're flat currently. We're turning more negative, but this is still looking more positive. And we're negative on the daily side with the Chaikin oscillator, where we're positive here. We're going up. We could get above this green line. This is when we follow this chart more closely. And we had come all the way up to the red line on the daily side, and now we're starting to come back down. This is still showing longer term strength for the time being. The vortex, negative, but the red line's coming down as the green line's coming up. We're crossing back above zero with the McClellan oscillator, even though we're declining, but we're above zero with the summation index based on price and volume. And the bullish percent index looking good on the daily side. We're above the 70 level. We're also above 70 here, and we're above the moving average on the daily charts, and we're showing some improvement. This was a bit of a concern earlier in the week. We were not seeing a lot of point and figure buy signals being generated, but that started to improve later in the week on the daily chart, which then ended up helping the weekly chart improve. And we're above zero with the swollen trading oscillator based on price and volume. We're declining, but still above zero with the PMO. We're trying to turn up long term. We're just barely turning positive now with the PMO, but based on price and volume, we're declining. We're also negative on the daily side, but the daily chart is just chopping along sideways in extreme positive territory, but it has yet to cross below its moving average, where this is starting to turn back up above its moving average. So we're back above 50 with the PMOs that are rising. That's an improvement, but we're still declining with the buy signals. However, we're still coming in at 52, and we're leveling off here with the PMOs that are above zero after we had been improving from the lows. Above the midpoint with the Bollinger Bands, looking here at the percent B, we're not getting an extreme positive or negative reading, but we are above the midpoint, so that's leaning more positive. And here's where we're looking at our oscillators. Starting to go back up with the slope oscillator, where we're negative on the daily side. We're turning back up with the TSI. We're flat on the daily side. We're drifting lower here with our 3 intermediate term oscillators on the daily side, where they're starting to improve and actually turning positive here on the weekly side. We're just starting to roll over on the negative side on the daily charts with the TRIX and KST, where these are starting to turn back up, but they haven't crossed over positive yet. We're positive with the Copic curve on the weekly chart. We're negative on the daily chart. We're positive with both the daily chart and the weekly chart with the force index. We're above 50 and going up with the money flow. We're also above 50 on the daily side. Then the Stochk RSI, we're just kind of floundering around the midpoint on the daily charts. We're actually showing some good momentum here with the weekly chart. And we're above 50, both on the daily side and here on the weekly side with the RSI based on 14 periods. And the Williams percent are positive on the daily side, positive here on the weekly side, and starting to get extreme with the ultimate oscillator. We did get right up to the 70 level on the daily side, and now we've been pulling back, but we're still above 50. And we had an up week, even though it wasn't up quite as much this week, but we're still above the midpoint with the week over week rate of change. And we are improving here with the 50-week rate of change. And we're still positive longer term. We're still negative on the daily side with the special K, but we're still hanging out positive longer term here. We're just a little bit above the moving average. And we're still above all these different support levels. I'm still just amazed when we came down and we hit that 50% fib retracement, which was already on the chart way before we even got there. And we just bounced right up off of that. It's just amazing how the market's watching these same things. And then we've been able to bounce at least back up to this point. And people say technical analysis doesn't work. How can you get more accurate than this? Tell me. Okay, so we are positive on the weekly side with the hike in Ashi. We're positive with the Kegi chart. We're black and pointing up. We're positive with the Renko chart. We're positive with the three-line break. We did see some new X's drawn in here. We're getting a double top breakout. It was generated this past week, so that's improving. We still have yet to go back and tackle the all-time high. And we're negative but improving with the ease of movement. Now, on the daily side, we're coming right back down to zero. We're just kind of fluttering lower with that where it had been positive, and it's picking up this lack of trend that we've been seeing on the daily charts. Now, longer term, the momentum. We are positive here with the long term, intermediate term, and positive in the short term. And as I thought I showed this before. Anyway, if you didn't get it the first time, we're still going down with the long-term equity put-call ratio chart. Okay, then we are positive with the Elder's Impulse system for the S&P, and we're positive with the parabolic SAR. We're also positive on the daily side. And we're still negative in the long term with mid-caps and small caps. And when we look at bonds based on price, still negative across the board. The dollar's still negative across the board. We switched over to commodities being positive in the short term. So just looking at the indexes, coming up nicely here with the S&P, still not out of the woods, and we're still not really trending yet, but it has been improving, where mid caps still lagging behind. Small caps had a good week, but we've been at these areas before here. I mean, we have with the S&P too, but we're seeing some improvement here with the small caps, but they've faked people out so many times over the last couple of years. It's like, okay, prove yourself first. Then the NASDAQ weekly chart in a downtrend, but we're above both lines. You're going to see that with these longer term charts. Dow above both moving averages, but still in a downtrend. Same thing with the NASDAQ 100. The mid caps still having a hard time getting above their 50-week moving average. And the small caps, they've got a ways to go to get back to their 50-week moving average. This is a daily chart. We're still above the 200-day moving average with the Wilshire. Downtrend, NYSE above both of the moving averages. All stocks starting to turn back up with the trend. Now, this is U.S. and global stocks, and global stocks have done quite well in 2025, and that's what's holding this particular ETF together. The FAANG Index, we just generated a golden cross on the daily side. Now we're just starting to turn back up here on the weekly side. So that's more of a confirmation, and these are the real big stocks. ARK, trying to turn back up, actually had a pretty good week, up over 8%. The banks still looking okay here, going back up based on momentum. We're above 50 with the RSI. Now we're into June, where we're up 80% of the time over the last 5 years with a return of 1.1%. Then this is just looking at the different indexes, with the Dow still having a ways to go to get back to its all-time high. The transports have been improving, but have been really disappointing on a ratio basis when we compare it to the Dow, where the utilities have been just pretty much chopping sideways, but kind of having a tendency to drift higher. Then looking at the commodities, weekly chart here, we're still in an uptrend and actually saw a bit of a bounce coming up here, up over, well, 3.6% on the week. Copper's still looking good, so this bodes well for the economy. Gold, still in an uptrend, but kind of chopping sideways over the last few weeks. Silver's in an uptrend. Actually saw a nice little spike here this past week. The dollar is still in a downtrend, both on the daily side and here on the weekly side. Oil, it's actually getting back up to the mid-60s, but it's been spending a lot of time in the low 60s and even a bit of the high 50s there for a while. All right, then bonds are still positive longer term based on price. We're still in an uptrend here. Now we have a new month, so we finished out May. So the stock to bond ratio monthly chart was positive, and so far it's looking pretty good for the month of June, but we're just getting started with June. Here we're seeing where interest rates had been coming down. Well, it depends on what you're looking at. Some have been going up, some have been going down. But we really saw interest rates going up on Friday, but that didn't seem to have much of an impact on stocks. Then the weekly side, we've been watching Japan, but that doesn't seem to really be playing out right now. And we're just kind of going along, chopping sideways here with the international rates at the 10-year yield. Then we still have gold, even though it's been coming down. It's the best performing asset year to date. Now we have stocks back in second place. Commodities, they're in third place. Bonds based on price have now gone negative. The dollar is now doing the worst, where oil saw a bit of a bounce up recently. It's still negative on the year, but it was in last place. Now it's next to last place here. Then we look at some ratios, and this is more healthy for the market. This is growth versus growth in value. When this ratio is going up, that's more positive for the market. Also, this is also helpful. The S&P 100 is outperforming the S&P 500. Those are the biggest stocks that make up the S&P 500. Growth to value. This is what we want to see in a more positive environment. And then gold has been starting to underperform as stocks have been going back up. And gold is really kind of holding up okay compared to the dollar because the dollar hasn't been doing very well. And we're going down again here with the longer term ratio between bonds and stocks. They really started to spike up as we were going down in March and April. Now this ratio is starting to come back down and continuing to do so. Low volatility stocks really spiked up when we were going down. Now they continue to go down as well. That's more positive for the market. Discretionary, still having some problems though when compared to staples. Just kind of gyrating around. It had been improving. It's not falling apart, but we want this ratio to continue to go up to be more positive. And we're still going down when we look at the energy to tech ratio. When this is going down, that means energy is underperforming. It was starting to outperform when stocks were going down. Now energy is underperforming as stocks have been going back up. And then small caps to the tech sector, even though small caps had a good week, they're still not really doing all that well when you compare it to the overall tech sector. Then some long-term trends, just really choppy right now with the ZWAG NYSE breadth thrust as well as the NYSE thrust. We saw a nice little upward move here, but not an awful lot of conviction right now. We're still above this long-term trend line going back to the 1987 crash with the S&P weekly chart. This is a blow up of that, how we fell below it and we were able to get back above that trend line. We're still down at zero with the Zohorchak method. For most of 2023 and 2024, we were at a full-on 10. Then we dropped to 8. Then we dropped to 4. Now we're down to 0. We'll be keeping an eye on this. If we drop down below the 0 level, that's going to turn this more negative. Right now, it's just at a midpoint. The NASDAQ 100 weekly chart, and again, I'll extend this line if it looks like we're going to really come back up and hit this again. But we've been really rebounding with the NASDAQ 100. We're still looking good with the NASDAQ 100 growth to Dow value ratio here. This ratio keeps going up. And the QQQs, which are growth to small caps, this ratio keeps going up for the most part. Still improving internally with the long-term moving average of the new highs, new lows for the S&P. We're above 0 and going up. And we're still negative, but we have been improving with the NYSE 50-period moving average. And we're still chopping along sideways with the 3-month yield and trying to turn back up here with the cumulative new highs, new lows. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial for the NASDAQ. Seasonally, now we're in the month of June, so average return 0.2%, up 58% of the time. A little bit better than a coin toss here, going back to 1964. And now we're in the June to November period, which over this whole period, we tend to be up 3.4%, about 2/3 of the time. And we're still in here now, the first half of June, which tends to perform better than the second half of June, historically going back to 1950. And then This is, we hit our low, at least for right now, possibly in April, and that bodes well for post-election years that maybe we hit our low and we can continue to go up. But this can always change at any time. This also looks better going forward, at least over the next few months, heading out into late summer. And then don't be surprised, we've already been below average with volume, both on the NYSE and the S&P. I mean, it's going to drop off even more once we get into July and August, and it's really going to drop off with the NASDAQ as well. Thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.